All right.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
All right. Glad I got that thing working again. Makes my life easier. All right, guys. So what's going on today? Anything exciting? Ask me questions so we can get some things going, but otherwise I will just babble on about some stuff. Let's take a look at the indexes and see what's going on. We have a pretty, we have a recovery, but it's basically until you're 50% recovered, it's not really recovery. So you have to pay attention to that. But as you know, 20% is your bounce, 20% of the drop is your weak bounce, 40% is your strong bounce. We're right about there here. We're right about there on the NASDAQ now. They're all basically the strong bounces. This guy's strong bounce is 1610. We just went over those lines. Maybe it's a good time to talk a little bit about the 5% rule, though. So I just talked about that, so it must be somewhere near the bottom. All right. Yeah. So look, the way the 5% rule works now, I'll just show you on the, all right. What are we looking at here? NASDAQ. So here's the NASDAQ. We had a drop, and I was counting 8,500, but if you count 8,450 to 8,200, that's a 250-point drop. All right, and you try to find a consolidation point here. But what I had said is I said, look, I think we should probably say that 8,400 is a real line because 8,000 is a very big support line on the NASDAQ. And so that means 20% over 5% over 8,000 is 8,400. So all this is a spike above the 5% line, but it didn't last, so we kind of throw it out. It didn't even last very long. And you can see that when you go to a bigger chart. That's why I love these charts because it's so easy to zoom out. Zooming out is very important because in the grand scheme of things, you can see here that even on a daily chart, it's only been up over 8,400 for a couple of days. On a weekly chart, it makes you realize that you're pretty much not even above 8,400 at all because it went up and straight down. And on a monthly chart, that's the amount you're over 8,400 on a monthly chart. So what the NASDAQ did do, which is what you'd expect it to do, is it consolidated under 8,000. Then it popped 5% more to 8,400. But you know what? If it gives this up quickly, then the whole move above 8,000 is a spike above. Because it doesn't matter. If you see only a couple of candles over something in any view, it means it wasn't relevant. If you see a couple of candles below, it wasn't relevant. So this dip wasn't really important because it didn't last very long. These are 2 months, by the way, but the dip didn't last very long. It was 2 months and back up. So in the grand scheme of things, it's not really a trend being formed on a monthly chart. Here you have the major trend, obviously, is going up and up and up and up. But even if you follow that line, it only goes to like the bottom of this thing. And we're really very much converging from where we should be, which is down around 7,000. I wrote an article a while ago talking about whether or not the NASDAQ could justify 9,000, and we actually found reasons it could. We found that it could conceivably go to 9,000 based on forward-looking projections in the companies that are in the NASDAQ. Could Apple be higher? Sure, it could be higher. Could Microsoft be higher? Yes, it could be higher. Are there some companies that shouldn't be higher? Yeah. But you know what? Even Amazon now has gotten a lot more reasonable. And so I wouldn't expect it to go too much lower than it is right now. I think it's about 1,800 now or something crazy like that after being, 2,200. Let's take a look. And the top 10 companies in the NASDAQ are like 30% of the index. So I mean, that's you don't really need to look past 10 companies. So it's not that hard to review them and figure out if they have value. So yeah, look at Amazon, way down at like 1768. And we were up at, it wasn't 22, it was 2,000. So it was 20,000, and the 10% pullback from that would be 18. And that's right about where we are, because now we're a little bit under the 50, or not the 50, the 200-day moving average at 18. The 50 days has been brought down because we spent a lot of time under the 200-day moving average. But in the grand scheme of things, given that this is what they call the death cross, right, where the 50-day moving average falls below the 200, it did not really have a big shock from there. It death crossed at 1,800, and since then, they haven't really lost more than 100 points, which is what, like 5%. So a death cross, which is a very strong bearish signal, caused Amazon to fall 5%. As to this, June, July, August, okay, that's where you go zoom out. June, that's also why I like these charts. June, July, August. You look at June, July, August, it was just a silly spike up. The whole thing should never have happened. Okay? All we're really doing in Amazon is consolidating along the 200-day moving average, and the next move up is going to be a solid move. I think it's really going to take them higher. And again, I'm not a huge Amazon fan. I think they were extremely overvalued. They're starting to finally grow into their valuation. Let's see if we can do that. I mean, still 80 times earnings. Where's my damn stock? Nope. I would have thought I had that up somewhere. All right, let's try putting it up here. Stockopedia. I like their spreadsheet presentation the best. Log in. All righty. AMZN. All right, so they're currently trading at $877 billion. So realistically, if I want to be paying 20 times earnings for Amazon, I should see 40 billion dropping to the bottom line. Even at 40 billion, I'm paying 20 times earnings. They are nowhere close to 40 billion. They're at 10 billion, 11 billion, 13 billion. So, even optimistic projections into next year, 13, 14 billion. How long is it going to take them to get to 40 billion at 20 times earnings? Even at this growth rate, and here you go, they were 2, 3, 10, and now they're 13. So let's assume, let's even give them 30% growth every 3 years. Let's say they grow 10% a year compounded. Well, now we can get our compound rate calculator. Aha, see, I love all this stuff. And then you say, well, okay, if they're at 13 in 2020, which apparently is in a month. So they're at 13 billion in earnings, 13,000 million, and we grow at 10% for 10 years. There you go. So they're a good 10 years away from even coming close to a 20 times PE. So, that's the problem with Amazon. That's why we don't play them bullish or anything like that. You can't short them, but you don't want to play them really bullish because it's just crazy. The valuation is crazy. I'd rather buy a penny stock and hope that they grow. I mean, it just is I don't understand. Why am I going to pay that kind of money? Why am I going to pay $800 billion, almost $900 billion for a company that is not going to even make 20 billion for the next 5 years? And especially when you compare it to Apple, it's another big ASDAQ, AAPL, sorry. So we compare it to Apple, who are making 60 billion now and are only worth a little bit more than Amazon. Well, not only, I'm sorry, worth, let's not say worth, who are only priced a little bit more than Amazon. So if I have, $1 trillion to throw around, should I buy Amazon and their $13 billion in earnings and hope for the best? Or should I buy Apple with their $60 billion in earnings and not have to hope for anything? Where's the logic in that? Why do people do this? It's such a weird thing when you think about it. It's like, why would someone do that with their money? What are you thinking? It's like there's no argument, there's no logical argument you can make to say the potential for Amazon is such that it's going to blow Apple out of the water in the next decade, at least, probably in the next 20, 30 years. And this is my other pet. Now, Amazon's got their web services. In fact, all their money really comes from web services, not from selling, tchotchkes. In fact, all right, what the hell? What did I just do? That was stupid. I just closed my thing. Futures, nope. Wall Street Journal, we don't need the Wall Street Journal. We'll change that to Phil Stock World. I just don't like to open too many tabs because then I can't even see what the tab is. All right, so I was just discussing this earlier. I don't remember if it was in the post or after the post. I think it was after the post. Oh no, it was in the post. Here you go. Okay, so let me expand this for you. Look at this. This is insane. This is Morgan Stanley. Supposedly they know what they're doing, but they don't, because if everybody remembers in the financial crisis, Morgan Stanley was like inches away from going bankrupt. Yet, they pulled it out. Other guys did not, but Morgan Stanley survived only because Bank of America took them over. And wait, is it Morgan Stanley? Wait, do they have a separate thing still? I'm thinking Merrill Lynch. Sorry. Yeah, it's Merrill Lynch that almost got up. So anyways, but Morgan Stanley had big troubles in the crisis. So where are we? Oh, you're right. Nope, it was this we were looking at. Right. Okay. So the logic of this analyst, which really cracks me up, and I'm sorry, because I didn't really explain this in the Morning Post, because it's like, it was, to me, it was like I just the chart said it all, but maybe it doesn't. So currently, you sell whatever this is. It looks like spaghetti sauce. You sell spaghetti sauce for $40, okay, and it costs you $28, and somebody comes to the store, and you make $12. Okay, that's nice. All right, so now Morgan Stanley says, look at how smart Amazon is, though, because they're gonna pick it and pack it and deliver it and make $2.60 instead of $12. So to make the same amount of money, they have to sell 5 times more stuff. Okay, and obviously they're should fuel prices go up, should labor costs go up, should a million things can happen to cause them to have a complete disaster in this program. Yet This is what they think is going to be sealing the deal for Amazon growth. So they're buying these grocery stores and they're building the stuff and they're getting trucks and doing all this stuff so that they can make $2.60 selling the same thing that a store would sell for $12, which is like almost about a 40% profit. So Amazon's like, no, we don't want to make a 40% profit. We want to make a 6% profit. It's just, in order to win with that strategy, they have to essentially take over the entire industry. But even then, they'll be running at a stupid thin margin thing that would make Walmart even laugh at them. And Walmart runs at like 3-4%. No, I bet Walmart runs better than that. Walmart doesn't run at that kind of profit. Walmart. Hard to tell though, because not Waste Management. That's a company to buy for the future. Walmart, because waste is becoming a bigger and bigger problem every day. So here's Walmart with, by the way, $500 billion in sales and 14 in income. No, that's terrible. Wow. So 10% would be 50 billion. So it's not 50 billion. 5% would be 25 billion. Nope. So something in the neighborhood of like 3%. So that's what Amazon's trying to do. Amazon's trying to become Walmart. But to do that, to become Walmart with that kind of strategy, Amazon is going to have to double their business. And if they're going to double their business by cutting their margins to 6%, what's the freaking point? It's not logical. You know, it's like revenue dollars don't always equate to sales. And of course, yes, Amazon's going to build loyalty by bringing stuff to you 2 hours after you ask for it. They're going to win customers. Although still, I have 3 ski houses. I have lived in several different places. I'd say there's no place that I've spent any significant amount of time in that's been more than 20 minutes away from a grocery store. And not because I purposely did that, just I'm saying it's just even in like Vail, Colorado, even in Lake Tahoe, I can actually walk 15 minutes up the street to the grocery store if I take my car 5 minutes to the grocery store in Tahoe. In Killington, Vermont, that's probably my worst one, and that's still only 15 minutes away from a grocery store by car. It's just not a thing. Where I live now, it's like 5 minutes in either direction grocery stores. Where I used to live, 5 minutes in either direction grocery stores. The Hunter, I have a place in Hunter Mountain. That one's probably 15 minutes by car to a grocery store. So, and then plus malls and whatever. So if I really want something in an hour, I can get something in an hour. You know, we have dinner here. We needed garlic last week, and we went and got it. Somebody ran over to the store and got it and came back in like 20-minute round trip or something like that. I wouldn't have called Amazon and said, okay, well, we're having dinner in an hour, and I'm going to hope Amazon shows up with the garlic. I mean, I understand how people can get used to that. I understand, like, if I use the last toilet paper and I can hit Amazon and know that I'm going to get my toilet paper before I even have to worry about it, great. Before my kids come home from school, I get my toilet paper, good. But do we really need that? And that, by the way, also, environmental criminalism. All this is wasteful. This is not efficient. This is not smart. This is not better for the economy. It's not better for people. It's not better for human productivity. We're wasting an incredible amount of resources. Look, all these people, these are all crappy jobs, packing and picking and delivering jobs. This whole segment of the economy that we could be building rocket ships or curing cancer or something. Instead, we're seeing how fast we can get a freaking roll of toilet paper to my house for 6% margins. What kind of stupidity is that? It doesn't matter that it's really cool that we can accomplish this feat of delivery of customer satisfaction, whatever you want to call it. It's just that it's a huge wasted effort, and it's unnecessary, and it's environmentally costly. Because even now, I just did in fact order like five I ordered like 5 things on Amazon that cost $20, and they're delivering it for free, and they'll deliver it in 2 days or less apparently. And it was just tchotchke stuff, like 5 little things that we needed in the fridge that I was like, I just opened the fridge and said, oh, we need this and that and that and that. And like pickles, like I could have gone to the store and gotten pickles, but I'm not, because while I'm calling Amazon, I do that. But the reality is, a normal person would write pickles on their fridge, and when I go to the store, I pick up pickles. That's efficient. I would have a list of things to pick up at the store. I would come home with 3 or 4 bags, and I would carry them in. And nobody would be picking and packing and whatever for me, and I wouldn't have to worry about that stuff. There wouldn't be 3 people handling the job. There wouldn't be an extra trip, because the car has to go from the grocery store to my house and back to the grocery store. Even if they have a route that they're following, it's still a route that didn't need to be taken. So I think it's not only a poor investment, but it's an economically poor decision by Amazon to pursue this path where they're going to spend incredible amounts of money, hundreds of billions of dollars, putting this system in place and all it really does is eat up the margin. It's not providing a service. How about, instead of doing all this, you just sit down with America, like get Mr. Rogers back, or have Tom Hanks do it, and sit down with America and say, hey, do you really need stuff this fast? Is this actually necessary? Like, let's all take a step back and think about what's important in life. And it certainly isn't getting everything in 2 days or for sure 2 hours. All right, see if anybody has any comments here. Uh-oh. Theo said, I lost audio and video. I hope he's the only one. Sorry, Theo. Hope you came back. And Bernie says, Cleveland Cliff, what's your view on the merger, given the synergies and savings and debt improvement? What's your target price? What's your time frame? Oh, my goodness. Look at all the work I got to do. I talked about that yesterday, didn't I? Yeah, let's see. I think we had a whole discussion about that. Just don't want to go through the whole thing again if I already had all the charts. Oh, yeah, that was the first thing we talked about yesterday. So DCS, what's my opinion of CLF buying AK Steel? And I said, and it's really big now, but I guess I'll leave it for the moment. Here you go. I said, I don't like it, neither do the shareholders. It's down, it was down 12.5% yesterday. I think it rebounded a bit today. Oh, see, it came up again. You know, I said a $200 premium isn't terrible, but I don't think it's the kind of market to take on integration costs. In other words, you know, it's fine to do it because AK Steel is a not too expensive stock, and Cleveland Cliffs is a not too expensive stock, and they're going to combine to be a bigger not too expensive stock. But still, the combination is disruptive, and it takes a while for the synergies to build in. So on the whole, what you're going to get, in my opinion, is a company that's effectively about 30% more expensive combined than it was without being combined, than the 2 companies were apart, and especially from CLF's perspective. But on the other hand, it's long-term a good play for Cleveland Cliffs. And I said CLF is in the earnings portfolio. We aimed low because we were selling the $7 puts, and we bought the $5 call, so we're still in very good shape down here. I wasn't worried about getting out of the position. Our target was 10. That's going to be a little bit harder to hit right now, but we do have 2 years, so it's not terrible. And I said we aim low, but I wouldn't get in it now, even if it gets back to our entry, which it didn't. It already bounced back up. So we entered, where do we enter on? 10.22. So we entered down here at 7. And I say, I think what this does is it just prolongs the amount of time they're going to spend as a lower, a little bit lower, but it's not terrible and they're already recovering. So, I mean, I certainly wouldn't sell our CLF stock. We didn't, of course. This is our position and we stuck with it. So it's not like I would get out of it, but I'm not going to say, oh my God, CLF is such a bargain down here. I think it's it's a neutral acquisition at best, but short term, it's obviously going to hurt it hurts their recovery. Now, all this is kind of over, and I imagine this may be more due to the fact that the China thing is, this was no China, and they dropped all the way. They had no China, and they made the acquisition, and now today China's back on, so it's going back. So the actual fall off in the acquisition wasn't as strong as you think. It was more about the China thing that everybody's freaking out about. But I do like CLF long term, and I don't think the acquisition is going to kill them. I just think that it's going to basically cost them a lot of time as far as integrating the companies and such. And but nothing I would get out for. No reason I don't like this position. I'm upset that it could have gone. We didn't need that to get back to 10. And then again, that's not what I cited. This article from Bloomberg, and I don't know if it was yesterday. I think it might have been Control F. Bloomberg. Nope. So it must have been Monday. I read this really good article in Bloomberg about GM. Well, let's go to Monday. I'll show you because it's an important article. I mean, if you're a value person, I strongly recommend this GM article. Hey, I wonder if I can put it into the thing. Let me see if I can do that. That'd be kind of cool. Then I can look all techie and impress you guys. All right, so we're going to find the article. There it is. Okay, so there's this great article about GM and what they're doing. What did I just do? Oh. And I really like the way these guys were analyzing it, and they're talking about what they're doing and how they're slashing things and the biggest layoffs, and they have to do this and that. But they are looking ahead to transition the company for the long term. They're looking 20 years into the future, and they have to make moves now because of the size and scale of GM. They have to make moves now to accommodate their future plans. And those moves are costly and expensive. They have to add electric car lines. They have to change the way they're building things. They have to change the materials that they're ordering. That means they have to have new relationships with people, around the world, and make sure they have supply chains that go across. So it's interesting because you think about all the stuff that they have to do because they're such a big company. Apple has this problem too. When you're this big and you decide you're going to, like Apple's going to obviously to go to 5G. And going to 5G doesn't mean you just go, oh, we're going to do 5G now. Apple's got to think about a dozen things that affects. It affects the housing in the phone. How are they going to put the chip in? Where's the chip going to go? What kind of antenna structure is it going to use? What kind of power is it going to draw? What kind of programs are they going to need to do it? How many things have to be rewritten to accommodate the 5G? It's an endless list of things that all have to come into place and all be ready by the time they roll out their 5G phones. And it's the bigger and more successful you are, like Apple, who have this incredible integrated ecosystem built around their phones, the more hard it is. Also, and of course, FaceTime, because now FaceTime, everybody who has an Apple phone is used to being able to FaceTime anybody who has an Apple phone. So like when I talk to my kids, I hit FaceTime and their faces, I see them. So I don't use the phone to really talk to my kids. I use FaceTime to talk to my kids. And I actually get annoyed with people who don't have FaceTime because it's you just get used to it and you say, oh, it's like, what's the matter? I can't FaceTime. And plus, especially when they have bad reception, because it's like FaceTime, as long as you're having a Wi-Fi, it works great. It doesn't matter about your cell reception. But Apple has to worry about all that stuff and make sure FaceTime does work over the cell line when people are out of touch. And they have to have programs like that. Their internal programs, external programs have to be compatible. And it has to then be backwardly compatible with LTE. And then they have to make a decision. Should it be with LTE and 3G? Are we going to go all the way back to 3G? Of course, you have to do 4G. But are we going to go all the way back to 3G compatibility? I mean, there are some people who have 3G. And what are you going to do? Just tell them tough luck, you can't use your phone? So the bigger and more successful you are, the more crap you have to worry about when you're planning for the future, because there's just more moving parts attached to what you're doing. And so this was a great article on GM and how you realize that perfectly good companies, and these are the kind of companies I often like to invest in, perfectly good companies can have poor current performance only because they're doing something to accommodate the future growth. And so when is there a better time to buy something than at a time like that? Oh, I'm sorry, I'm gonna see if I can do this. Control C. So I highly recommend this article. And let's see if I can put this, let's see if I do this. And go like that, and go enter. Did that work? It seems to have worked. I don't know if you guys can actually click on it, but that would be kind of cool. It looks like you can. I mean, I can. I don't know what your boxes look like. Oh, I seem to have just responded to Corey. I didn't put my own comment in. Oh, I see. Hang on. Send to all. There you go. That work? All right. Well, hopefully that worked. If not, it's in Bloomberg Business Week from September 19th. GM's Mary Barra, it's big on electric cars. So anyway, I like articles like that. It really makes you think, and it gives you an idea of what I'm talking about, though, because a lot of times people say, well, what do you like them for? How come what do you want to invest in them? What are they doing? And Cleveland Cliffs is the same way, okay? It's like, a lot of big successful companies go through up and down cycles. And to me, it's like if everybody's getting out just because they're in a down cycle in a cyclical business or they're in an investment cycle in a business, I'm like, that's very interesting to me. Look at GE. Remember those guys? Remember how they used to be a powerful company? GE was all the way down to $7. Now they're back at 11. That's more realistic. 7 was crazy. It's freaking GE. They were reorganizing and doing stuff. IBM too. IBM sold off for a while. They were reorganizing and doing stuff. It happens to a lot of these companies. GM and Ford. Look at GM. Where are we? So here's GM. They're down in their slot. That's a decent price. Not great, but decent. And Ford is especially good. I think we picked up Ford in one of our portfolios. Let's take a look in a bit. Ford is also down a bit low in the channel and also a great place to come in. But these things, they go out of favor, people sell them off and whatever. And at times like this, when the market crashes down and you can pick up blue chips for these kind of prices, you got to be able to jump on those situations. And frankly, look, we went to cash because, we cashed in all these big portfolios and have all this stuff sitting on the sidelines. But the question is, are we going to actually get a sell-off? It keeps not happening. You can see the tendency of the market to sell down. In fact, even today's rally is fading out a bit. There's a tendency for the market to sell down, but there's nothing indicating a real correction is coming. So that's why we start up these portfolios, because it's just getting boring. Even though it was only, when did we cash out? We cashed out in late September, and now it's late. Now it's December, so October, November. So basically 2 months, a little more than 2 months, we've been sitting on the cash. And I got bored last month, and we started putting up some more small portfolios, but only small ones. And I think I'm picking good stuff, so we'll take a look at that unless there's any questions, and there's not, so good. Let's see. Is this working? Very slow. What's going on here? I don't know. How about if I do that? There we go. I knew it somehow logged me out. Let's try this again. There we go. So look at that. The short-term portfolio has already popped back to 55%. I think it really was only about 56% last week at its height. And you know, what kind of look, and that's from 10/1. So October, November, all right, so 2 months. So in 2 months, 55% gains. And what did we pick? A long on CBS. We sold puts, not a big deal. This one's our biggest winner, Booking.com, the old Priceline, and we thought they would not. That we figured they'd be short, and here we are coming into January. We have a bear. No, I'm sorry. We have a long bear put spread. So 2021, a year from now, our target is 1900. We're at 1900 now. But I also, against the bear put spread, it's hard to, it's tricky to think the opposite way, but we have a bear put spread, so we make money at 1900 or less, right? And we make quite a lot of money. We only paid net 17,000, and it's a $20,000 spread. Oh no, I'm sorry, it's a $40,000 spread that we bought for 17,000. So we make $23,000 at below 19. So selling the $1,800 puts to pick up $10,000 seemed like a really good idea, because we got a $23,000 buffer, plus it has to drop another 100 and something points before this thing's even in the money, and then we can roll it for a whole year before we have to pay. So, you know, I thought Booking was overpriced, but not that overpriced. It's working out exactly perfectly. If we stay above 1,800 into January, then this expires worthless. We pick up the last $3,000 here, and this thing's a home run. I could close it, or we could sell more puts. You know, it's just crazy. So fantastic moneymaker there. Freeport McNamara is just a basic long-term bull call spread. We went with a 5-10 spread. It's at 11 now. So we're obviously in good shape there, 100% in the money. We sold the $10 puts, and that's that. And I'm not going to look at the charts of every one. I mean, just to give you an idea. The MJ ETF is actually, did it finally bottom out? Well, that one I'll look at the chart for. That's the cannabis ETF. But unfortunately, it's mostly Canadian cannabis, which has had very, very rocky time. But yeah, see, it kind of found a floor finally. So hopefully it'll start perking up from here. But certainly nothing to write home about. But fortunately, we sold the January $20 calls. They're going to expire worthless, and we're going to make $800 there, which doesn't sound like much, but it's nice while we're waiting. Philip Morris, also a good one. This is in the money, so we don't have to worry about that one. That's just moving along nicely. TLT, we took the 148-140 bear put spread for January, so it's already, you know, coming towards it. Now, oddly enough, though, look at the money. We've hardly made any money on it at all, even though it's in the money. We're not being treated very well by this spread so far. And we also sold the June 2020 145 calls. Also, you know, we picked up 22% on them, but also not treating us well at all. The volatility of TLT bonds. Well, the volatility of TLT, you can see from the notes. You know, all this volatility is keeping the internal VIX of TLT like really high. So it's very painful for us as far as that goes in the position, but still logically it's a good position. So I mean, it's basically saying that the Fed is not going to keep easing. That's basically all we're saying. The Fed is not going to ease further from where they are now, and therefore this price of TLT is too high. And then in Tesla, we did a split. These are about to expire, so I'm thrilled. We're going to pick up the entire 5,000 blah 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 dollars on that one. And now we sold. Now this is tricky, because what we did is we sold the short puts. So I'm saying Tesla won't go below 250, and we picked up 26,000 on the short puts. So what does that mean? If Tesla goes higher, we make $26,000. That's my buffer. That no other position, no other thing. The $25,000 is my buffer against the short calls we're going to sell every quarter. So in November, actually this is only for a month. In November, we sold the December calls for $5,000. That was for one freaking month. So here we are only a couple of weeks later, and we're up 82% on these short calls. So all I intend to do, and you're not going to be able to do this every month, but all I intend to do with Tesla is TSLA. So what I intend to do with Tesla, because it's just so freaking, the money in this thing is so incredible, is every time it's high in the channel, we're going to sell calls. So in November back here, see, this is when we sold the calls. I said, that's stupid. I have to sell calls at that price. So now they're going to expire worthless in 2 weeks. I think it's the 365 calls that we sold. They're going to expire worthless. Now, hopefully, we'll be up around 350, and I'll sell more 365s. I might not get the same amount of money, but who knows? So let's take a look. In fact, if we go to Tesla, TSLA. And by the way, some people are watching these webinars and they're not members and they're watching like weeks later or something like that. I just want you to know all this stuff is not that complicated. It's that, we say sell a put, do a call, make a spread. It's not that many things really to learn. We've never had anybody who hasn't been able to actually learn this stuff. And that's what we do here. But you have to, you have to make an effort. It's not like magic. You can't just suddenly say, oh, I'm going to trade options. You have to learn these things. But once you learn it, it's an incredibly powerful tool. So let's see what we can do here. We're going to page down. Ugh, really? All right, what do we say? The 2 365s. So if we were to sell the January 365s, oh no, look at that. You get 750 for them even now. That's pretty good. So we sold the Decembers for $11.70, and now we can get $7.65, which is about $4,000 for the Januaries. Now, that's a month. We got 24 months to sell. So even if we only get $3,000 a month for 24 months, that's $72,000 of sales potential against this $2,600 short put, which is also, we think, is going to expire worthless. So in this little portfolio that started with $100,000, doing stuff like this, I can make $100,000 just on that position. And all I'm doing, understand the protection though. The protection is that the 250 puts are $100 out of the money, basically. I don't think Tesla will go below 250. Even if it does, though, I think that by the time it gets there, I will have sold another $25, $30, $40, $50,000 worth of short puts. So that means my buffer on 5 contracts is going to be $100 per contract to the downside. So Tesla can go all the way to 150 before this trade is really a failure. So my margin of error is down to 150. Now, to the upside, the same thing. Since I'm collecting the 26,000 for sure, if Tesla blasts higher, I get the 26,000 for sure, and that works out to 500 times 500 is 25. Wait, no, 50. 500 times 50 is 25,000, right? Yes, 500 times 100 would be 5,000, 50,000, 50, yes. So I have a 50, trust me on this, I have a $50 buffer to the upside. So Tesla would have to be over 410, because if it's at 410, this is going to go worthless, and I'll have to pay off the callers. But I'm collecting 25,000, 26,000 here. That's enough to pay $50 more for the callers, not even including how much I sell the short calls for. So that's my buffer to the upside is 410. Tesla, I'm basically saying Tesla won't go over 410. And to the downside, I'm saying Tesla won't go below 150. And I've already collected $30,000 to that end, which is $60 per contract. So at least 190 I'm covered to, even on my first sale. So anything between $190 and $410 on Tesla, we're going to make some good money. And that's a pretty wide spread. That's basically, if it's at 350 and it's 190, it's about $150. It's like 40% in either direction that we're good. So that's why I like that trade. Now, that being said, these are advanced option tricks in the short-term portfolio. Now, the short-term portfolio is the portfolio that's paired with the long-term portfolio. So the long-term portfolio is $500,000 to start. All right, we had a couple of million by the time we finished it last cycle, but we started with 500,000 in the long-term portfolio and 100,000, 1/5 of the amount in the short-term portfolio. So the margin we have, since we have no long-term positions at all, and I mean we have no long-term portfolio positions. Some of these positions are long-term, but the margin we have is such that we can afford to make plays like this and not worry about the margin. Because we have 500,000 additional cash sitting on the sideline for our other portfolio, which we have not yet started. So we get to have fun with the short-term portfolio. And even when we do add positions in the long-term portfolio, we tend not to be margin aggressive in the long-term portfolio. It's a very conservative long-term portfolio, full of positions like this, full of positions like FCX, full of positions like MO. Those are long-term portfolio type positions. Okay, but not MJ, not TLT, not Tesla, not Booking. Those are not positions that CBS would be in the long-term portfolio. Those are short-term gambles that we would stop out if we didn't like the way they were performing. But FCX and Philip and Altria and that's it. Well, CBS to some extent, but FCX and Altria, if they turned lower, we would add to those positions most likely, because they are those blue chip stocks I'm talking about. These are huge, long-term prosperous companies that may be going through reorganization. With Philip Morris, it's the vaping thing that took them down. With FCX, it's the trade war that's taking them down, but it's not going to kill the company, and it will pass eventually. Even if Trump gets reelected and it takes 4 more years, it will pass at some point. Of course, we said that with Bush, and it didn't really work out, because then there was a horrifying catastrophe. But in theory, we did not imagine. I remember that, because when Bush got reelected, people were like, "Why are you so upset?" And I was like, we were like, "It's a disaster. This guy is horrifying. It could get worse." We were worried about the war at the time and things like that. But it turned out economically, he destroyed the country and the world, frankly. Which is funny, because it was a savings and loan crisis, just like his father. I mean, that's, they're just, these guys, they just favor their friends and their buddies in certain industries, and they let them run rampant, and the whole thing falls apart. Trump is, with the land developers and the oil people, is just destroying the environment. There's 15% more pollution now than we had 3 years ago. He's ramping up pollution 5% a year. Every year, 5% more pollution. That's crazy. It almost is where you say we can't survive 4 more years of Trump, and we can't. 4 more years of inaction on the environment may be the tipping point for the entire planet. But anyway, don't want to get into that. So even if things are horrifying and Trump does get reelected, still at some point you think that hopefully we'll come out of this trade nonsense and everything else. So that's what we are basically playing for there. So this portfolio, though, very aggressive, but very profitable to be aggressive this way. We make full use of our theory of be the house, not the gambler, where we sell as much premium as we possibly can, and we let time do its work. We sell premium to other people. We have $150,000 of cash in a $155,000 portfolio because we are selling premium in every one of these positions. We're selling more premium than we have positions. We only have 4,900 in positions. Our total value is $4,900. We sold, well, as I said, we sold, look at this, 37,000, 2,000, 3,000, 1,000. This is all sold premium. 23,000. There's $100,000 of sold premium in this portfolio. All it has to do is expire, and we make another $100,000, which is 100% of this portfolio. That's why our last short-term portfolio was up like 800%, because it was just crazy. We just kept making these bets, and they kept going well like this. This is up 55% in 2 months. This is following our rule. Be the house. Sell premium. Figure out what's wrong in the market. What's mispriced. Booking was too high. Tesla was too high at the time, but I figured out a good way to play it both ways, which made me a lot more comfortable in doing that. TLT, because of the Fed and all that, was too high. Philip Morris was too low. The MJ ETF pays you too much money to sell short calls, not to do it. And again, here's in June. So, we have the long-term spread. We think it'll go higher at some point. But even if it doesn't, I don't really, we don't care, because we're going to make a lot of money selling this premium every month. We could sell more, but we were hoping it would pop higher. But every couple of months, we're going to be able to sell $1,000. And let's say it's only once a quarter, we'll sell that's still $8,000 we get to sell over 2 years while we wait for this thing to come in. $8,000 is the net of this spread is $9,000, $10,000, $11,000 is the entire net of the spread. So if we cut that down by $8,000, we cut our net down to $3,000 on the spread. It's like it's almost hard to lose when you do things like that. But again, we're selling a lot of premium, and most of our money is on the sideline. Now, we have $500,000 that's allocated for the long-term portfolio, totally in cash, not doing anything. But even against $600,000, making $55,000 in 2 months is almost 10% in 2 months on the entire amount. That's pretty freaking good. So what else do we have? We have the Butterfly portfolio. And this does not reflect the adjustments we made. It's up 104% now. But that's been a couple of years in the Butterfly portfolio. These are stocks where we are expecting them to basically stay flat. And again, selling a lot of premium makes a lot of money. But the Butterfly portfolio is not like the short-term portfolio. It's very conservative. We have generally very conservative plays. We have a neutral stance more or less on everything. Unless it gets way too high or way too low, we stay neutral. And we just try to sell as much premium as we can while we're waiting. The dividend portfolio obviously is about collecting dividends. That's up 6% though, which is almost quite by accident. It's only been a month. And that's not even, well, I don't know. I don't want to say it's not counting the dividends. At some point by the end of the year though, there'll be a bunch of dividends coming in here. And we worked out the numbers. When we did our dividend portfolio review, we wrote exactly how much money we're supposed to make on that. And I said, since this portfolio is full, see cash on hand minus 16,000. So if we assume we have $200,000 in margin in the portfolio from $100,000 cash start, that we would have still 80 something thousand left. But at this point, we're pretty much full in the portfolio. We don't want to do anything. So I said, you know what, that's fine, because I can make I can take a portfolio and forget about it, because there's not going to be much effort on my part to doing anything. I'll just every once in a while I'll report where the dividend portfolio is sitting, but it won't take a lot of maintenance for us to worry about it. And I thought it'd be interesting to just now freeze it and say, okay, we picked up a dividend portfolio. These are the positions. And now we're going to leave it alone for 2 years and see how close it comes to our plan of making 37.5% a year for 2 years. And those of you who haven't seen this is what we do at PSW. We map out every single trade. We map out how much money will this trade make in how much time. And with every single trade, as we do our reviews pretty much every month on these portfolios, we say, are we on track or are we off track? And if we're off track, do we need to fix? Do we need to make an adjustment to get back on track? Or is it hopelessly off track and we need to cut and run? But that's how we look at all of our positions. They on track or off track. So these guys, even before they paid out their dividends, doing very well. When they do pay out their dividends, we'll probably pick up about, well, let's say nothing would be in here if it didn't pay at least 5 or 6%. So let's say 6%. So every quarter, we should get 1.5% in dividends. Now, since we're full with $122,000 worth of positions, that means that we should get about $1,500 more per quarter. So that would be another 1.5%. And if we end up making this quarter 7.5%, that's very much on track for us to get to 30+% by the end of the year. That's all it is. So it's doing exactly what it's supposed to do. But I thought it'd be fun just not to touch this at all. So we set it, we have a plan, and we'll see how it executes without being bothered. The earnings portfolio, obviously, we were looking at stocks that have earnings. We only started that 10/21, so just over a month. Cleveland Cliffs just had a fallback. It was doing much better, so we had a little thing here, so it's only up 3%. Hanesbrand not moving. Boeing, we expected Boeing to start recovering. It's actually, I mean, look, Boeing's actually, it's up technically $2,000 here. It is a $25,000 spread that's now 100% in the money. Where was it then? Chart. BA. Oh, okay. See, we picked it up here. Like it was looking bad when we came in, but I was like, no, and again, it's math. We sat there and did the math, and we said, no, they'll have a rough time, but they should survive this at about this level. So it came back already. It's already at our target. Our target was really modest. We said, we think it'll get back to 350 in 2 years. So we're already at our target. It is a $25,000 spread, and we paid net $11,000 for it. So there's 14,000 potential profit, and currently it's only at 13,000. So frankly, as a brand new trade, you're still going to make $12,000 on this spread if it just holds 350. All right, so 12 into 30. I mean, it's like 90%. So basically, you'll make about 90% on the spread if it holds 350 for Boeing. All right, that's in 2 years. So I don't know what else I can say to people. I mean, it's like people say I don't understand how you can make money like that in the market. I'm telling you right now, here, this spread has an incredibly good chance of making 90% in 2 years. And it's in a blue chip company. All they have to do is fix their frickin' 737 MAX, and God knows they're motivated to do that. And if they fix it and they can fly it, even if it costs them a lot of money, even if it's a problem, even if they have to change something drastically in the plane, as long as they fix it and don't have another problem, they will go back to being a $400 plus company, and you'll be sitting on a 90% profit in Boeing. Not in blah, blah, blah pharmaceutical if they cure cancer, not in this other weird company, not in some Chinese bullshit company, not in some crazy tech company that you heard is good or whatever. It's freaking Boeing. You can make 90% on Boeing, betting that it's going to stay above the price it's at now. That's all it has to do, is not go lower than 350. And it doesn't have to not go at all lower. It can go lower and come back. But I mean, basically 2 years from now, you're saying Boeing will be at 350, even though, and let's keep this in mind, okay, even though Boeing was $438 earlier this year, even though it was above 350 pretty much all of last year. It was up and down, but around the 350 line. And this year it was moving a little bit higher. And that's what Boeing should be doing, by the way. Should be going here, and then it goes up. And you know what was going on here? When I was banging the table for Boeing, a couple of years ago, it was in the down part of a cycle because they were investing heavily in their new planes. And nobody wanted any part of them because they were spending money to roll out their new planes. Now, it turned out their new plane's a bit defective, but still a new plane. It's done. They're done with most of that cycle. Now they just got to fix the problem that they have, and then they should be fine. And if they are fine, they've got orders for billions and billions and billions of dollars worth of planes. They already have the orders. They just have to basically stop it from falling out of the sky and then deliver the ones that they have over the next 10 years. They have 10 years worth of orders backlogged to make incredible amounts of money. This valuation is way low right now compared to what the orders that they have on the books. And they did not, by the way, get many cancellations. That was very interesting. That's the one thing you've seen, is that because the thing is, if you cancel, if you chicken out and don't want the 737 Maxes and you cancel your order, if you change your mind later, you'll be in the back of a 10-year line. So very few airlines have canceled their orders or changed anything. They still have all these orders in the books and they're still ready to deliver, and all they have to do is just ramp this thing back up. But they got to do it right this time. They cannot afford another screw up. So there's your risk, is that the Boeing is completely incompetent. But if they're not completely incompetent, it's going to be a great trade. So I'm telling you now, there's a trade that can make you 90% in 24 months. So do with that what you will. But to me, everybody acts like trading is so hard. And it really isn't. It's just, in other words, I can buy a $300 call. Boeing's at $350. I can buy it for $83. So I'm paying $30 a premium, okay, for this call. No, its full value is $53. I'm paying $83. So basically $30 is premium in this price. So what do I do about that? Well, you know what I do? I take the 350 calls and I sell them to a different sucker for $57 in premium. This guy's paying $27 in premium more than I am. He's paying all of my premium plus another $27. So what do I end up with? I end up with a $50 Boeing position plus $27 that this sucker is giving me, which then gets cut in half because it's 5 contracts. So basically it's going to be $13,000 of profit potential. That's the position. This is not complicated. There's no brain teaser here, okay? I've got the position for $50. That's mine. I own it, okay? And this guy paid all of my premium for the $50 position plus another $27 on top of that, which is just bonus money I get to keep if Boeing is above, it doesn't matter what happens. In fact, I'm sorry, whether Boeing is up, down, or sideways, I get his $27 no matter what happens. I cannot possibly not get his $27. I'm completely covered for Boeing being from, no matter how high Boeing goes, I'm $50 below him. So I will absolutely get $50 on anything over $350. If Boeing is below $350, he gets 0, and I get whatever the difference between $300 and $350 is. And I'm sorry, and wherever it ends up. So if it's $325, I still get $25 times 5 is $12,500 back. And I only paid $11,000, so I'm still making a tiny bit of money on that. But that's how that works. So I already know Boeing has to be below 325 for me not to make money. Anything over 325, I make some money. Anything over 350, I make a lot of money. It's a simple position. It requires no margin. It can go in an IRA. It can go in a 401k. It can go in any account that you have. It's a covered call. It's a covered spread anyway, but it's like a covered call. It's not a complicated position. It's not a high risk position. It's a blue chip frickin' stock. All right, and I don't want to belabor the point, but I mean, for God's sake, it's 90% in 2 years. You got to take these opportunities when you have them. All right. Anyway, so CLF, obviously, they just bought AK Steel, so we'll see what happens there. IMAX, another one. All right. Also, still trading at the same price. IMAX is very China dependent for their growth, but so far, nothing in the trade war has bothered IMAX. It hasn't affected them because they're really not importing anything or exporting anything. They are basically a service provider to China. They're not, they build theaters in China, license their technology, and Chinese people go to the movies. From China's perspective, they are employing Chinese people, and it's just being used in their technology. Now, 2 years ago, okay, I forgot who, but somebody came out with an IMAX-ish product. Maybe it was Sony or somebody like that. But anyway, so somebody else who has some theater chains, so I think it was Sony, came out with something that's kind of like IMAX. And they were pushing it in their theaters. There's something called DX or something like that. That's another digital thing that AMC Cinemas is pushing. No, I'm sorry, not AMC, Cinemark. Cinemark is pushing a technology that uses like Dolby Atmos and digital DX something, whatever. Anyway, there's a couple of different formats of high definition, whatever. But the blockbuster movies are all filmed in IMAX. The top directors want to work with IMAX. All the nature stuff, all the planetariums, IMAX. You can't just have competing technologies. They have to catch on. IMAX already caught on and is already being used all around the world by thousands and thousands of theaters. To change that now, even if you come up with something better, you have to not only get the theaters to start adopting it, but you have to get the directors to start using it. And that's a big thing, because it's been 20 years of IMAX pushing and training and getting film crews to work with it. And there's a whole generation of cinematographers and editors and sound people and everybody who work with IMAX equipment and understand it, use it, and like it. To get a big budget film to go to a different format is very, very, very difficult. So it's a huge moat. That's what Warren Buffett likes in companies. He likes to see a moat, and there's a huge moat in the IMAX. And of course they are dependent on things that they can't control. They're dependent on the box office. They're dependent on good films being put out in the IMAX format. They can't control that. Not every movie is going to be a big hit. Although right now, I am baffled at why they're still so low when you've got Frozen breaking Thanksgiving box office records. What are we betting on right now with IMAX? We're betting on Q4's performance. What's going on in Q4? This frickin' movie Frozen is blowing everything out, and then comes Star Wars. So last weekend, in its second week, Frozen, in its second week, it didn't open Thanksgiving. It opened the week before Thanksgiving. In its second weekend, Frozen broke the Thanksgiving records for a movie, not even being a new movie. So that's phenomenal. It's going to be another $1 billion picture, which is good for Disney too. It's another great company, but it's going to break all the records. And then comes Star Wars, which is almost a guaranteed $1 billion movie. And obviously IMAX is only 1,000, 2,000 out of God knows how many theaters, probably 20,000 theaters in the world, but they get their share and they have premium ticket prices and so on and so forth. And also you got to think about the theaters and the money they put into the screens and the size of the things and all this. It's not going away. It's not like going to suddenly disappear overnight. This is a great business. And here we took June because they don't have, the problem with IMAX is they don't have long-term calls. If IMAX had long-term calls, we would play them constantly. But this is short-term money. So we only picked these up on basically November 1st, which is 30 days ago. It's already up $700, but that's still not much. The spread itself is 1822, so it's a it's a $40,000 spread. 4 times 2,000, 40,000, correct. Wait, no. Sorry, 8,000. I'm really bad at this. It's an $8,000 spread. I don't know where my brain is with math today. It's an $8,000 spread. I'm sorry. And we paid net 85 minus 35 is 5, a little less, another 1. So 4, 3. So we paid about $3,000 for the $8,000 spread. It's still only 5 and minus a bit more is, well, let's say 1.1, 4.1, 5.1. So let's say it's about 3.9. So it's $3,900. It's still an $8,000 spread. So this one by June, not by 2 years, this one by June is going to make over 100%. If IMAX is over 23, it's at 2160 now. Now it's definitely riskier because you are basically betting on the box office over the next few months, but I think they are very, very underpriced. And as you can see, we had a very good morning today. Came up nicely. And they've been drifting along here. And that's the 50-day moving average, and that's the, I'm sorry, and there's the 200-day, so they're below the 200-day moving average. What happened is the 50-day was coming up, it got rejected at the 200, that sent the stock came down, it was going down anyway, and then it tried to come back up, but it's very tough to get back over when you got the 50 below the 200, and now it's zigzagging, and we're down here, and hopefully it'll consolidate around here, and the 50 can start turning back up, and then boom. And then you've got the opposite of a death cross, but it tried doing that before. It tried doing that here and failed. So they've been having a lot of weakness, but it's silly because if we go back to IMAX, IMAX, really? The search on this is so annoying because it shows you every country on the planet. And I don't care. It's like I don't want that many symbols to be searched. Anyway, so it's only a $1.3 billion company, but they're making, last year they only made 22 million. This year, $67 million. Now, that seems crazy. That seems like a lot of money. So let's check. Let's make sure there's not something wrong with that. So go IMAX. Whoops. IMAX. No. Yahoo's getting bad too. I don't know. I think somebody must have sold these guys an algorithm that just sucks. Okay, so here's IMAX. Now we want to go quarterly and see if they're really making $60 billion. And yes, they are. Look at that. Look at that. 30. Ooh. No, that's not it. Sorry. Incorrect. They got 10, 20, 30. So they're 30 so far this year. I don't see how they're going to make 30 million in the final quarter, though. That doesn't seem very likely. Last year, they only made a couple of billion in the final quarter. So that number is wrong, or we don't know where they're getting it from. So let's assume they're at 30 billion. I'm sorry, let's assume they're at 40 billion. So they were at 22 billion last year. I don't know where they're getting this number. But let's say they're at 40 billion now, and let's say next year they do 50 billion. 50 billion on I'm sorry, 50 billion. Not billion, million. It's not $1 trillion company. It's $50 million, sorry. So $50 million with a $1 billion valuation is fine. It's like 20 times earnings, maybe a bit more. But they are growing very nicely, this company. It's not like a piker. You know, they're moving their revenues up. They spend a lot of time and money. They developed new systems and did stuff. They've streamlined the process. They went digital. That's why it's ramping up faster now, because they went digital, and that's really easier for the theaters to adapt to, and they're moving forward, and a lot more people placing orders. Again, like Boeing, huge backlog of orders. So although IMAX is a little bit pricey from a PE perspective against the current value, I think they're growing well enough to make it work. And again, it really is about box office for these guys. It just very much depends on what kind of box office they get. I think the fourth quarter is going to be great. And hopefully that's going to give them a little pop and kick them up to where we need them to be for the future. But again, it's not Boeing, so I don't have the same super strong feelings that this thing's a no-brainer, but it also pays off really well between now and June. And you know what? If it doesn't, just roll the position and we give it another 6 months. So I like that position too. iRobot, another good one. They've got iRobot was my stock of the century at the beginning of this century. And we lost interest in them when they sold off their military division, because I really liked their military division a lot. They sold it. And they sold it because they didn't want to be associated with war machines that were killing people, which was basically where they're going with these things now. As if anybody ever thought they weren't going to do that. But like, you know, that's what the Army's doing. They're making autonomous killing machines, just like the freaking Terminator. You know, not just like, it's not going to be a human looking thing. It's going to be a drone with guns, which we're already using right now. It's going to be just little mini tanks that drive around shooting people. Is whatever whatever works. They're going to kill people with. I guess if you're the guy who has the toys, it sounds reasonable because you're not putting your soldiers at risk to murder other people with robots, but it's wrong. You know it's wrong. you know it's bad. Having wars because you're not going to get killed makes you more likely to have wars, right? It's like, well, we're not going to get killed, we only kill the other guys. That's what evil people say. So anyway, that I'm not happy about. And they weren't happy about it either. So God bless them, they sold it off. But we dumped them when they did that because we said, well, we don't want to be a part of this company if they're not going to have killer robots. But they came down to a price finally where we said, okay, you know what? I don't mind it down here. So very profitable at the moment on the call side. The short calls dropped a lot in value. That's what helped us. Our long calls didn't drop as much in value. It says the stock generally is down from where we had it. It's actually lower than where we came in, but because these calls had such stupid high prices, we came out well so far. Anyway, so it's a good trade. It's not really playable now because we already made too much money, but that's a nice position there also. Oh, and I'm sorry, and the growth in iRobot is they already have the vacuum cleaners, but they also have mops. They now have robot mops. They're going to have robot window cleaners, and they already have, other companies have robot pool cleaners. That's iRobot's getting into that too. I used to have a robot to clean our pool. It was an Aqua something, I don't remember what it was, but it was I think it was like $3,000, and it would just spend all. I mean, everybody's seen pool cleaning little. They're not really robots. The pool cleaning things that just go around the pool from the hose and just randomly sort of push things around. But this isn't like that. This is a tank, a little tank that goes in your pool with treads, and the motor, which is running off the water pump. It's not. Oh no, I'm sorry. It's electric. Sorry, it is electric. The electric motor is running a pump that sucks the water up through the middle, and that causes a whole robot to be pushed down hard on the treads. So now it's like right touching the surface, and it has scrubbers, and it goes along every inch of the pool. The robot maps out your pool, and it runs a little routine, and it goes every nook and cranny and everything on your pool, including the steps, actually climbs up the steps and cleans them one at a time. It's crazy. It's just sitting there constantly cleaning your pool. And our pool was sparkling all the time. I'd never had a pool like that. It was so great. And it was a robot. It just, no matter what, all day, all night, it was just cleaning your pool. And whenever you wanted to go swimming, you just retrieve it, pick it up out of the water, and then when you're done swimming, you drop it back in and it starts cleaning again. But that pool was pristine constantly. So very worth it. I mean, don't forget, people who have pools don't really worry about, people who have in-ground pools aren't really worried about a $3,000 robot cost. And it was well worth it because, I mean, otherwise we would have had to have a lot more guys coming over and cleaning it on a regular basis, and that would have cost money anyway. So let's see. Comments. Can you please explain what would happen with your MJ position if the price goes above your short call strike in the short term? Not clear how your short-term calls are covered in the short-term portfolio. Okay, Theo. Challenge accepted. Let's see. It said short-term portfolio. Okay. All right, so please explain what would happen in your MJ position if the price goes above your short call strike. So I assume he means these short calls, $20 calls. First of all, we have 30 of the 15-30 spreads, right? So we're covered with 30 times 15 is $45,000 of upside. We paid, forget these. We pay, well, no, don't forget these. I mean, we pay 21 minus 11 is 10, minus 1 is 9, minus 1 again basically is 8. So we paid $8,000 for a $45,000 spread. This is only 5 short calls. let's say it goes to 30, right? What's going to happen? Well, then this guy gets back 10 times 5 is $5,000. We'd have to pay him back $5,000. But MJ would be at 30, and these guys would be $45,000 in the money. So we would lose. What do we collect? 800. We'd lose $4,200 here, but we only paid. I forgot what I said now. 10, 9. We only paid 9, and we're going to make 36,000 here. So 36,000 minus 4,000 is our profit, $32,000. So that's what happens at 30. At 40, we don't make any more money, and we would have to pay him now $10,000. But still, 29,000 or I'm sorry, whatever the number was, $32,000 minus. I forgot that 45, 37. We paid 8 and it's 45. Therefore, the profit is 37,000, right? 37,000. So it would be 37,000 is our profit here. So this, and this, anything to the upside, 37,000 is profit above 30. So if this is 40, we owe him 10. If it's 50, we owe 15. If it's 60, we owe 20. We still make, I forgot, whatever, $17,000. So that's all that happens. Now, in reality, though, that's incredibly unlikely to happen. We're going to roll the short calls to a higher strike to avoid paying them off for as long as possible, and hopefully they'll eventually expire worthless. We can always add more longs, but we already have 30 longs on 5 shorts, so there'd be no reason to do that either. We could also roll the 5 short $20 calls to, let's say, 10 short. This is January, so let's say we went to 10 short June 30s, and that would be maybe an even roll. So there's lots and lots of ways to adjust it, and it's like a chess game, though. So it's kind of like saying, if he moves his queen to that spot, what are you going to do? And there's a lot of things you could do. It's like chess. You're not backed into a corner. You don't have to forfeit the game. You have many, 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 many outs, and some will lead to a good path and some will lead to a bad path. So you have to evaluate what happens after your opponent makes a move, and effectively, your short caller is your opponent. But he's the one who's restricted. He's playing a short game because he's got a problem. He only has one move. He has a short $20 call. He has a long $20 call. He has a long $20 call, and the only thing that can make him win is for MJ to be above 20. If it's below 20, his calls expire worthless and he's out. So the only move he gets is for it to be above 20, and then he gets money, and hopefully it's up above 20 enough that he makes it. He paid $1.60 to us, so it has to be $21.60 before we even have to give him more money than he gave us in the first place. And we do want MJ to go higher, just not so fast that it puts him deeply in the money. And even worse for this guy is that we are the ones that control what happens to him. We decide when we're going to pay him off. We decide whether we're going to say, no, we're not going to pay you, although effectively we are paying him and somebody else steps in. But, realistically, we're going to say, we're not going to pay you. We're going to just roll your position. And now you're going to have to play again in June and see how you do. We control the action. We decide when we want to move and when we want to do something with it. It's incredibly powerful. And that's what we teach people here. This is how you manage these positions. And the only way to learn, though, is over time, because there's no way to say if this, then that, if this, then that. It depends on how much it moves, when it moves, why it moves. Do we think it's a silly thing that it moved up for? Did it move up for like a long-term benefit? Like, let's say one marijuana company gets bought out by another marijuana company for some stupid price. But then we say, well, that was one strategic buy that's not likely to be repeated. But then the whole MJ ETF pops 20% because one company got bought out for a high price. Then we'd say, well, that was probably a temporary thing and it isn't going to last and should not affect our long-term investing decisions. All right, so that's a possibility. It just depends on why it went up and why it was a problem. But in this particular position, because we're 6-to-1 covered on the long side, and with a very wide spread, it's almost impossible for this position to hurt us. All right, but on the other hand, we sold. Well, let's see. When we started, it was October, so we sold 44 plus 45. So we sold 90. We sold 90 out of 850 days. So maybe we have 8 more chances to make these sales. So let's say we sell this $800 8 more times. That's $6,500 more we get to collect. And $6,500 plus this is 12, 13 plus 5 is 18. So our net, or I think I said that before, our net on the spread will be like $3,000 by the time we're done, by the time we whittle it down. $3,000, it's still a $45,000 spread. The profits will just increase because we keep selling this. But like I said, selling $800 is nothing. We're selling 1/6 of what we have covered on the long side. So we have almost no chance of getting hurt by this position. That's the beauty of it. That's why it's such a great play. All right, so where were we? I forgot. Earnings, I guess we go, yeah. Then we have the specialty portfolios, Hemp Boca, which we do on the radio. I didn't do the radio this week. Did we just do this, or is it the same as another portfolio? Is Hemp Boca the same as earnings? Well, I'm very confused. We did earnings, right? Oh, yeah, because it's got IMAX and iRobot. Interesting. Okay. So Hemp Boca is for the Hemp Boca show. It's basically flat at the moment. We got hurt with Molson Coors, but that's okay. So this is our main position. We have a Molson Coors, and we again, blue chip company was down. The vaping thing was bad for them. Not the vaping, I'm sorry, the cannabis thing. They invested in cannabis. The cannabis thing is not going the way they wanted to. Bad investment. They've got other issues, and the Canadian dollar is super weak, all kinds of problems, but nothing they're not going to work their way out of. So also still a very strong play. Again, well, I guess this is another important one we should look at. So we go TAP, T-A-P. You have to be very, very careful because this might be priced in Canadian money, which means you have no idea what it's really worth. Revenue, that doesn't help. I'm not sure this is American dollars. Let's assume it is. That's interesting. I'm trying to see if it's, well, it's got an American, I'll assume it's American. I'll assume it's priced in the US dollars. I don't see anything indicating it's not. So 11, let's say $11 billion at this price. And last year they did $1 billion in revenue, 1.1 in fact. This year probably less, next year even less. So they're good for 900 million, let's say. Okay. So going through a rough patch, but still a reasonable return on your investment. And we are playing them conservatively. We're playing the 50-60 bull call spread. So I think that they're worth a little more than 10 times earnings, but they only have to get to 12 times earnings to hit 60. So over the course of the next 2 years, I think they'll stabilize and move a little bit higher and come up to this level. And also, and any improvement in the Canadian dollars and so on and so forth will be a huge improvement for these guys because they're effectively exporters. IMAX, again, same thing, same good thing here. Here we have a lower target though, because because Hemp Boca has been around longer. Hemp Boca is from May. So we picked this one up back in July when we had a much better price, and we only were going for 21 on IMAX, and that's coming up now. So that's going to expire in the money exactly where we want it to be. Macy's, also one I've been banging the table on, although obviously not performing well, but this is ridiculously cheap. You can still play this from scratch. I think Macy's is ridiculously underpriced, and I think that'll show up eventually. Again, with the MJ ETF, this one is We sold these 2021 calls. It's a little different. We have a more conservative target on this one. Oh, I'm sorry. This is a leftover loss also. That's why these are a leftover loss from an old position. This is a new position we put on, and we're just leaving these. There's no point in taking $1.23 for them. We got a year to go. We may as well hope it comes back rather than take $1.23 off the table. Tenet Healthcare, THC, great hospital group, already deeply in the money. I mean, it's at $33 and we were shooting for 20. So deeply in the money, almost a full pay, almost fully paid. It's let's see. It's a $7,000 spread. 22 minus 16 is 6. Minus 1,000 is 5. So it's 5,000 out of 7,000 that potential. So it's going to make 2,000, which is still 40%. So it's got 40%. And again, it's funny how we ignore this stuff because it's going to make 40% by the end of the year. And all THC has to do is not fall 33%. If it manages not to fall 33% between now and the end of the year, this spread will make 40% in 1 year. That's good. So, I find it's just funny to me sometimes. It's like, okay, so 40%. At Phil Stockwell, we used to like all these things that make 200, 300%, whatever. But this is a nice solid play that makes 40%. There's nothing wrong with making, if you didn't make 40% last year, and last year was a good year. So if you didn't make 40% last year, here's how you can make it next year. Got that one, you got the Boeing play, you can put together a solid portfolio that's going to make 50% next year without taking a lot of risk. I certainly recommend doing that if you in any way are not making more money. If you're not, if last year wasn't a 50% year for you, then really you got to think about like just sticking to these safer plays and not screwing around so much. Money Talk, that's fun too. We just restarted that one on 11/13, so it's not even a month old yet. And what did we do? We did SunPower. We sold short puts in that one. That's can be done from scratch. That's an easy one. Gold is our stock of the year, our trade of the year. So far, it's up. Yeah, I mean, you can't complain. It's up 52,000. It's up $1,000, $1,300 in a month. So I don't know. What do you expect out of a trade? We only spent, this is 10,000, right? So 10 minus 5 and 5 is 15. So we only spent less than $1,000 and we're up $1,000. So we're up 100% in the first month on this net position. That's not bad, right? And the spread is a $12,000 spread. So we spent $1,000 on a $12,000 spread that's already 100% in the market. Now, if you take the spread now, it is 17 minus 10 is 7 minus 4.5 and a bit here minus 5, let's say. So it's basically a 5,000. Wait, sorry, no. 17 minus 10 is 7 minus 5 is 2. Right, okay. So now it's a $2,000 position, but it's a $12,000 spread that's 100% in the money. And all gold has to do, all ABX has to, or gold, sorry, Barrick Gold, they used to be ABX. Now all they have to do is hold 17 where they're at now for 2 years, and you will turn $2,000 into $10,000. Now that's exciting. That's a 500% gain. So that's got to be fun for somebody, right? I mean, this seems like a good trade. I mean, honestly, you should probably put the whole portfolio into that one position, right? I mean, just take $20,000, put it in that, and it'll make $100,000, and that's it. You're done. There's your trade. And honestly, I can't tell you why not. There's no reason why not. This is a great trade. I think gold's going to be a lot higher in 2 years. Gold, the substance, not the stock, but this will be higher too, and that's that. I think it's just stupidly cheap. Also stupidly cheap, IBM. This one is flat. It's actually down, so you can get it cheaper than where he came in. The net of this spread is now a credit, right? Because that's 16, 17, and this is 5, so it's about a $1,200 credit if you start the spread from scratch. And it is a 20 times 800 is 16,000. The $16,000 spread that you can get for a $1,200 credit. That's pretty good. I'm in favor of that. And what are we betting? We're betting IBM is going to go from 132 to 140 in 2 years. And now if you want to talk value, you know what? I'm going to do this next time on TV with these people, because I mean, for God's sakes, it's like, this is how, this is what you do to make money. What is this? Showing me the English version. Here we go. All right, IBM. So big projections. I wonder if they're going to hit that. Let's see. That's interesting, because look how fast that went up. Now, they went through restructuring. Nobody wanted to touch them because they did exactly why I want you to read that GM article. They restructured. Nothing was wrong with the company. See the sales? 79, 79, 79, 77. They restructured. They weren't going down in sales. They just cut divisions that they didn't see being the future in favor of stuff they do see being the future. Mostly cloud services and things like that. Watson, stuff like that. So let's see if their crazy plan is on track to make $11.4 billion. So we say IBM. And we go quarterly. And they got 1.5, 2, 3, 4, 5, and not even 6, 5.6. Nope. Where are they getting these numbers from? I'd give them 2 billion tops in the next quarter, so you're going to come out of 219 with 7.6, which is pretty much, it's right around where they were last year. Maybe they'll hit that, maybe they won't, but they're not hitting no $11 billion. I don't know where they're getting these estimates. That's several times we've seen a way too high estimate for these companies. It's very interesting. That is not normal. Something is wrong with their algorithm on this on these guys. I'm gonna actually have to call them and find out what's going on. Anyway, so market cap, even so, they're making $7 billion. They're at 117. They're roughly trading at 15 times earnings. And I do think they are going to start growing revenue on a better path. Not that path apparently, but a better path. It's really weird. This is new. This is a new thing, because that's why I keep that. This is why, by the way, this is why I always check my numbers, because you can never trust something just because you see it doesn't mean it's going to happen. And this is just really strange that they keep coming up with these funny numbers that are way too high. Let's see if anyone's got questions. Nobody has questions. Okay, good. Going to wrap this up shortly. All right, there's that. So again, though, IBM, very strong feelings about it. And don't forget, you're paying net nothing. It's currently a credit to buy this position. So you're not going to make 16, you're going to make 17 something $1,000 because you got the credit, plus you make the money. So even anything above $120, you make money. I'm sorry, no, take that back. It has to be over 135, otherwise the short puts kick in. But realistically, your break even is probably somewhere around 127, something like that. And I don't see any reason that we're not going to hit this number. 140, that's certainly obtainable. So again, it's riskier than Boeing. It's not a sure thing, but it's a very, very good bet on a blue chip company. And the worst comes to worst is you reevaluate and you reposition, you roll it, or you sell some calls if you don't think you're going to hit your target. Lots of ways to fix it down the road. And don't forget the thing about the money to our portfolio. Hemp Boca, I'm on almost every week. I wasn't on this week just because I was too busy. I'm working on a project. So I can go on Hemp Boca anytime though, any Tuesday when they're doing their show, and I can just make an announcement and change your position. Not so with Money Talk. Money Talk's TV show. If I want to make a change, I have to go on the show. I only go on the show once a quarter, and I can't really rush on the show. I can't really tell them to change their schedule because they book guests like months in advance. It's only a once a week show. So I can't go in there and say, I got an emergency trade. No. So we only trade this once a quarter on the show. And so these are all what I consider very, very safe type positions that are very unlikely to have problems. It's brand new. It's not up much, but these are great positions. They could all be done from scratch. And didn't we already do the short-term portfolio? We did. Oh my God, we've gone through all our portfolios. How cool. All right, good. So there we are. I feel very good about that. I'm done with questions. Nobody has any other. Oh, wait. JC says, when will you be loading the portfolios into the virtual portfolio tab? I will do that no later than this weekend if you remind me. It's not that hard. I just had to go back and find all of our reviews from last week and put them together into one post. But I will do that. And by the time I do that, it'll be the middle of December, and we'll be ready to do the next one. But anyway, so yes, I'm sorry. I should have done that this weekend, but I just with Thanksgiving and all that, it was kind of a crazy weekend. So I'm getting around to that now, and I've got this huge project going on in Thailand, which I'm almost ready to talk to people about. Huge thing in Thailand that's going to be hopefully gigantic for us on the CBD side, doing the CBD company that we own. Anyway, so that's it for now. Thank you everybody for coming. I appreciate it. It's been good talking to you, and we will do this all again next week. All right, take care, everybody.